In this recording, we're going to be looking at Task 1 from the Level 4 PDSY Practice Assessment 1. Now, Louise Harding has requested you to analyse the published results of a competitor, using your detailed understanding of their financial position gained whilst you were recently employed by them. As an accountant, you have a professional duty to keep information about former employees confidential. Therefore, this request directly threatens the principle of confidentiality. We were then asked how we should respond. So the most ethical response is to refuse to use the confidential information. But the correct response would be to base your analysis entirely on the public information that's being given. Hina Khan, who is the cashier, is preparing a cash flow forecast. We've been asked to show whether the following items should be included in the cash flow. So the revaluation of premises we would not include in the cash flow. And the reason for this is because revaluation of premises is a non-cash item. It changes the book value of an asset, but does not involve an actual inflow or outflow of cash. The bonus issues of shares in SLP Limited. Again, we would not include this in the cash flow. A bonus issue or stocks dividend is a distribution of a company's reserves in the form of additional shares to existing shareholders, and it doesn't involve any cash movement. In terms of the payments of dividend on ordinary shares, this would be included in the cash flow. And that's because the payments of dividends is a cash outflow and it is distributions to profits of shareholders. When we write off obsolete inventory, we wouldn't include the value in the cash flow. And this is because writing off obsolete inventory is just an accounting adjustment that reduces the value of inventory on the balance sheet. It's a non-cash expense. Moving on to Part C, Liz Hall, the Accounts Payable Clerk, has asked you for some advice. She wants to know whether the following errors and discrepancies will be detected by reconciling the Accounts Payable ledger to its control account. Looking at the first error, a supplier invoice has been paid twice. This would not be detected. The Accounts Payable Control Account reflects the total amount owed to suppliers. Both payments would likely be correctly recorded as debits in the control accounts and also as debits in the individual supplier accounts. While the supplier account would show a zero or even a credit balance indicating an overpayment, the total balance of the accounts payable ledger, which is the sum of all the individual supplier balances, might still match the control account balance. The reconciliation focuses on the total amounts, not the details within the individual accounts. A supplier invoice has been posted to the wrong supplier account. Again, this would not be detected. The Accounts Payable Control Account records the total value of purchase invoices received. Even though an invoice is posted to the wrong individual supplier account within the ledger, the total amount owed to all suppliers remain the same. Therefore, the sum of the balances in the individual supplier accounts will still likely equal the balance in the Accounts Payable Control Account, and the errors won't be flagged by the reconciliation. However, a cheque payment has been debited to the Accounts Receivables Control Account. This would be detected. The Accounts Payable control account tracks payments made to suppliers. If a payment is incorrectly debited to the accounts receivables control account, which tracks money owed by customers, this payment will not be reflected as a reduction in the accounts payable account balance. However, the individual supplier account in the purchase ledger would likely show the payment. This discrepancy between the control account balance and the sum of the individual supplier balances would be identified during the reconciliation process. Moving on to the VAT on some purchases which have been omitted from the VAT return would not be detected. The reconciliation of the accounts payable ledger to its control account focuses on the gross amount of the transactions with suppliers. The VAT return is a separate document dealing with the tax implications of these transactions. An error in the VAT return wouldn't directly cause an imbalance between the total owed to suppliers, as reflected in both of the control account and the ledgers, and the individual supplier account balances. And lastly, a purchase invoice has been debited to the account of a supplier. This would be detected. This is a subtle but important point. When a purchase invoice is received, it should be credited to the supplier account, increasing the amount owed, and debited to the relevant expense or asset account. If the purchase invoice is debited to the supplier account, it would incorrectly reduce the balance owed to that supplier in the individual ledger. The accounts payable control account, which summarises the total of purchase invoices, i.e. credits, would not reflect this incorrect debit. Consequently, the total of the individual supplier balance in the ledger would not match the balance of the accounts payable control account, making the error detectable during reconciliation. Moving on to Part D, Liz Hall maintains the accounts payable ledger. Her duties include ensuring that the accounts payable ledger agrees to its control account. The question is asking what sort of access should Liz have to the accounts payable control account. And the correct answer here is a read-only access. Liz Hall maintains the accounts payable ledger and reconciles it to the control account. To maintain segregation of duty and prevent fraud, she should only have read-only access to the control account. She should not be able to make entries to it. As inventory count is to take place at SLP's limited financial year end, Sue Hughes, the chief accountant, is concerned that the inventory value will appear too high. And she suggests that the inventory receipts in the final week of December should be dated the 1st of January, and that those items should be excluded from the count. The relevant purchase invoices should be posted in the new accounting period. This would significantly reduce the reported value of inventory. For 2 marks, we need to identify which one of the following describes the suggestion. The correct answer here is fraud. The reason for this is deliberately misstating inventory receipts and excluding them from the count to understate inventory and reduce reported profits is a fraudulent activity. It is deliberate misrepresentation of the company's financial position.